Good afternoon and welcome to CFA UK's Wednesday webinar at 1. My name is Gerhard Sobel. We're absolutely delighted to have Adam Forsyth from Cantor Fitzgerald with us today. The evolution of finance in energy has seen innovative solutions evolve over time. The market is now facing major disruption as a result of energy transition, with new forms of energy production set to replace traditional forms, particularly in electricity generation. These new forms of production are generally capital intense, cash generative, and subject to new and evolving forms of risk. They impact the wider industry in different ways, creating risk and opportunity at a structural level. Industry forecasts show substantial growth in deployment and investment, which in turn suggests high demand for finance in one form or another. Adam is an equity analyst covering independent power, new energy, clean technology companies, and in the UK and internationally. He initially worked for an environmental charity before completing an MBA in 1991. After building a pan-European utilities research team for Robert Fleming, he became joint head of Pan-European Utilities Research at JP Morgan. In 2002, Adam left to co-manage activist fund management company Platinum Fund Managers. Returning to the sell side in 2008, his investment research now focuses on independent power, new energy, and clean technology companies with Cantor Fitzgerald. He has been ranked in the Starmine and Excel Industry Awards and is a member of CFA UK Energy Finance Special Interest Group Leadership Team. This presentation will take about 30 minutes, followed by Q&A. Please participate in the Q&A session using the appropriate box on your screens, as it is not every day we have Adam here with us. Adam, over to you.
Thank you, Gerhard, and good afternoon, everyone. As Gerhard says, I'm going to talk about financing the energy transition. As he said, I'm an equity analyst, so my background is equity more than debt. And as all equity analysts, I tend to be outside companies looking in rather than inside looking out. So this will tend to be an overview. I hope I've got the level right for everybody, but there will, of course, be the chance to answer questions at the end. Just move the slide on. Obviously, we live in a regulated world, so here's a quick disclaimer. Just for the avoidance of doubt, I will not be giving any investment recommendations today. And for those of you entertained by MiFID II, this talk will be a minor non-monetary benefit. And finally, a word from our sponsors. We've recently set up a special interest group within CFA UK to cover energy finance. And 5 of us have got together under Elisa at the front there to create an interest around this theme, which is obviously a rapidly evolving part of the world. If anyone is interested, and I suspect by taking part in the webinar you will have some interest, please get in touch. Please either join the conversation through the address given there or have a look at our LinkedIn group site on LinkedIn or contact the CFA directly. It'd be very good to have people taking part. We're hoping to do more events, more webinars, and actual physical events with speakers throughout the years going forward. So, my topic, financing the energy transition. What I'm hoping to look at are what we see within, what I mean by the energy transition, what the world means by the energy transition, and where expectations around that are developing, how that's leading to changes, particularly in the new energy world, and particularly the electricity world, what that will mean for investment, what types of assets those investments are going into and how they might shape investment going forward, and a little bit of the history of how financing for those assets has developed, and then looking forward how the environment looks likely to change and some of the developments that we're seeing, particularly in financing around those changes. it is an evolving environment, and I think that makes it interesting. Hence my discussion today. So the energy transition, which I think we can define as a move from a largely fossil fuel-based energy mix towards a low carbon based energy mix. A lot of expectations, a lot written in the press and in more learned places. But if you look at forecasts, these forecasts from BP Energy Outlook, in the transport world, the impact doesn't particularly look as great as I think some of the press might suggest. We're not seeing forecasts here of a massive move to electricity replacing oil-based transport fuels. Obviously, the source is giving one forecast. There are other forecasts out there. There are forecasts out there which show a stronger move to electricity, and forecasts are never spot on. One of my favorite quotes is, all models are wrong, some models are useful. But I think this is useful because it's useful that if from the same source we contrast with the stationary world, i.e. the provision of particularly power generation, and again from the BP source, their forecasts show a stronger move to low carbon sources of power generation. So at the moment, I think in the real world, as opposed to maybe some expectations, the energy transition is particularly about power generation rather than transport within the energy space. And one of the things that's changed in the power generation world has been the cost of the new forms of generation, the costs of particularly photovoltaic, solar, and wind generation have fallen dramatically over the past years. Solar panels have come down partly with volume, partly with a move of manufacturing to China, and a fairly aggressive ramp up in manufacturing from China. Wind energy too, though, the cost has come down. In some ways, part of that cost has been the simple fact that turbines have got bigger, and the scale effect of that has caused a reduction in costs. These figures are from Lazards, who publish an annual levelized cost of energy survey, and this gives a cost amortized over the life of the various generation assets. But you can see here that solar and wind have fallen below the levelized cost of gas generation and coal generation and nuclear generation. And here we are just actually seeing the ranges of outcomes. This is actually last year's survey. Those who are interested might like to see, and it's available online. Lazards now have their most recent survey just came out last week, I think. And again showing utility scale solar and normal wind at ranges below the costs of other forms of generation. I would say these figures are based on the US. There are differences around the world. And there are differences in individual assets, of course. I will say more on that in a moment. But in terms of geographies, for example, if you look at the UK, there are the impacts of what is effectively carbon taxation, making gas and coal even more uneconomic compared to wind and to solar. So we are at a point where wind and solar certainly can make sense on a pure economic basis. And that, I think, has rather changed the picture of what the drivers are out there. Quite a number of drivers for new energy. In the past, a lot of it has been driven by policy, by various climate change initiatives. And actually, increasingly, we're also seeing policy around particulate emission and the need to simply clean up the air here and now as much as cleaning up the air for its impact on potential global warming in the future. There are other drivers out there, but I think the change that we're seeing at the moment is that the drivers are moving from being primarily policy-based to being much more based on simple economics, and therefore the cost of energy, top right in this diagram, but actually also time to market is important. The timing it takes to put up a solar farm or even to erect even a large wind farm, these are shorter timescales than you're looking at for most of the traditional forms of thermal generation, and a lot shorter, certainly, than nuclear, and particularly when you factor in the planning and permitting requirements that you see around nuclear. I think that time to market story is particularly important in the developing world, where countries are growing quickly and want to see generation coming in fast. And I think in those geographies we'll see an extra driver. But as I say, I think strong drivers, which are policy is still there, but economic drivers are now important as well. And that, I think, means we will see more and perhaps even a more rapid transition to new energy than suggested by the BP Outlook forecast. And here's someone else's forecast just to prove that point. This is Bloomberg New Energy Finance, their new energy outlook forecast. And you can see the uncolored portions of this graph, which are essentially representing low carbon sources, showing strong growth and very strong growth out to 2050. And I think, on the ground, we're seeing this happen, that new generation is tending to be low carbon in nature. So just looking at that generation, and I think it's important to understand some of its characteristics, important from a financing perspective. This is a slightly simplistic view of the cash flows of a typical wind farm. You can see in year zero a large capital spend, large cash outflow. Although costs have come down, CapEx is still the main cash outflow, obviously, to get these assets on the ground. But once on the ground and once up and running, income streams obviously come in, but there is no fuel cost. In fact, I think I've sometimes used the term fuelless generation instead of renewable generation, because I think it's an interesting thing to bear in mind. You're not having to buy coal, you're not having to buy gas, you're not having to buy oil. That means that the cash generation from the revenue is essentially covering a small operations and maintenance charge, and the rest is largely going to interest and debt repayment. I've shown in this typical farm, and this graph shows a subsidy, so there's an assumed feed-in tariff or green certificate income, and I've shown that for a 20-year period, and then below the line in the costs out, I've shown interest and amortization. Sometimes the assumption is that the amortization is there up until the period of the subsidy, and perhaps this graph should have shown the subsidy disappearing in line 10. That doesn't always happen, though, but there are different forms of debt around, but sometimes they are matched with subsidies. And changing subsidy patterns, I think, is going to be quite important going forward. But the overall picture here is that it's a big cash outflow at the beginning, and then these projects are fairly cash generative going forward. Another thing to say is, obviously, that showed you pictures per year. Actually, if we missed a slide here, that shows picture. This graph shows annual cash flows. Bear in mind that these are dependent on weather patterns in each year, and those obviously vary year to year, but over time we should expect them to return to mean. And I think that's been an issue for financing, and I think it's an issue that's been quite easily dealt with, largely by statistics, so that we're used to using essentially averages of output, and equity funders have become reasonably happy with the mean, essentially, which is a P50 output. And debt providers have looked to figures based on our P90 output. In other words, the output that statistically would be expected roughly 90% of the time. I know that's not the formal definition, but I think that's a good way of looking at it. And that's based on maybe 3 to 4 years of data that has been collected before the project goes ahead. And so that variance, as it were, I think has been dealt with by financial markets quite well. There is still risk in that, and we have seen some insurance products evolve which have dealt with that risk for those who feel the need that it needs captured elsewhere. obviously, based on the forecast we've seen, there is a lot of investment required. And actually, again, this is one set of forecasts in many. This is Bloomberg New Energy Finance suggesting 11.4 trillion US dollars required to 2050. I have actually seen bigger numbers out there, but certainly there is a lot of investment required just to meet up with demand for electricity going forward. And going back to the very first slide, of course, if transport really takes off, if electric transport takes off, then we will see even more demand for electricity. We've tended to see declining per capita demand in the developing world, in the developed world for energy. I think if we see electric vehicles pick up, then that will tend to reverse that process, and we will see per capita demand start to grow again for electricity, particularly. Sorry, here's the slide. This slide shows that we do see variance, obviously, year to year. This is UK data for average wind speed. And as you can see, no 2 years are the same. But from a financing perspective, we can deal with this essentially using statistics. And I think the market has got very comfortable around that approach. One thing I would say is site by site is very important. You can't assume any wind site is the same as another. The output of a wind turbine is related to the average wind speed cubed. So if you have a site that's twice as windy as another site, it will produce 8 times more output and therefore 8 times more revenue. Now, nobody goes for the bad sites, so you don't actually see that range in practice, but it does illustrate that site by site is very important, and that needs to be taken into account in financing decisions. So just to look at finance, well, you can see that finance comes from a lot of sources. We have utilities being a major player, perhaps very obviously. But I think also we've seen the market open up to many other different types of players, and quite varied and quite mixed. And I think that is probably quite good. I think it means that different types of assets can be funded in different ways. But there's no one dominant source, which I think is also quite interesting. And what's actually being financed? Well, generally the finance is going into the assets themselves. There is funding going in at corporate levels through public market issuing and through corporate bond issuings. There is finance going into early stage, so early stage technologies or early stage approaches to the sector, because we still have technologies developing. I've talked about PV and wind. I think tidal power is coming back on the scene to an extent. We have other types of solar. We have actually interesting developments even in wind itself. We have, obviously, we've gone from onshore wind to offshore, and offshores we've seen cost reductions. We're also now seeing solutions such as floating offshore, which is interesting. It gets around a lot of locational issues in offshore, but still expensive and still very much a new technology. We are seeing some funding going into those technologies and development like that, but the bulk of funding is going into assets. And so asset finance dominates. And within that, I suppose some ways of saying the same thing, most of that money is going into projects themselves, rather than into manufacturing or technology development. And so the types of financing we're seeing on the debt side, way back, we would see normal corporate debt being deployed, and I think way back it was probably fair to say that utilities themselves were probably bigger players, and state actors as well. Perhaps state-owned utilities were bigger players, but what we have seen is a growth in project finance. So special purpose vehicles being set up with non-recourse debt funding, very much matching the liabilities and cash flows of individual projects. As I said before, projects can differ project to project quite a lot in this area, And I think that is why this has been a very appropriate source of funding. And it has grown and probably now the dominant source of debt funding for these assets. Corporate finance, though, remains important, and the other evolution we've seen in corporate finance is the growth of not just corporate bonds, but green bonds. So bonds which are marketed in such a way as to be delivering essentially green credentials, either low carbon or environmental credentials. And we've seen quite strong growth in this area. Still perhaps a relatively small part of the debt market. I think there's been a lot of comment recently suggesting that more can be done here, particularly around standardization, particularly around getting definitions in place that funders can rely upon. But it has grown as a form of financing strongly in recent years, and I think we will see more going forward. Then on the equity side, equity and the approach to equity, I think, has differed according to the phase of projects. This graph essentially shows what you would expect. And obviously, the earlier stage of a project, the greater perceived risk. Permitting in particular, and particularly in places like the UK, getting particularly onshore wind projects through planning has been a major source of risk. But once that's done, we have some construction risk over time. Of course, that should have reduced, but it's still there, and some operational risk as well. And if you probably squint at this slide, it does kind of show top left to bottom right line, if you were to try and put a best fit line on this, with higher returns being demanded at the earlier stage of projects, as one would expect to compensate for that risk. But quite a number of players essentially smearing that risk over the project life, and therefore perhaps getting or requiring a lower rate of return in the early stage in compensation for a higher rate of return at the end. And quite a variety of types of funders. Pension funds, I think it's no surprise that we see pension funds in this market, given the cash generative nature of the assets, but obviously wanting to come once the assets are proven, matching their risk appetite. And then at the earlier stage, you can see that project developers sort of standing alone and taking quite a lot of risk and wanting to be paid for it. Utilities perhaps being able to smear that risk around both by stage, but also by having perhaps larger portfolios and portfolios of different types of business. But I think the one interesting thing on the equity side that we've seen over the past few years has been the emergence of yieldcos. So these are largely closed-ended investment fund type vehicles. I talked about pension funds and companies like pension funds liking the cash flows that they see from these assets. One of the problems has been is that individual assets tend to be quite small. You know, that's quite an important statement. You know, nuclear coal-fired power stations, we tend to talk about thousands of megawatts. Solar and wind projects may be hundreds or tens of megawatts. So the work needed to be done on each project might be the same, but for each project is very small. So a degree of aggregation is actually quite welcome, and yieldcos, I think, have provided that aggregation. And they have, on the whole, been successful. US yieldcos had a major wobble. Sun Edison collapsed. But I think we're seeing them beginning to actually mature again and becoming more interesting. But in the UK, I think the yieldco story has been very strong. We're obviously living in a low-ish interest environment. There is, I think, in reality, a premium for yield out in the market, and I think that has been met and met by assets which can deliver, and hence we've seen yieldco is performing well. And I think that has been an interesting evolution and an innovative evolution within financing in this area. So looking forward, I think we're going to see slightly more unsettling times. Partly we'll see it through price volatility. The marginal cost of a renewable energy asset, certainly a fuelless renewable energy asset, is very low, may actually be zero. And actually where there is a subsidy, assets may bid into power markets at negative prices in order to get paid the subsidy, because they will only get paid the subsidy if the asset actually runs in the market. And that has created negative pricing. We've seen it in the UK, we've seen it in Germany, we've seen it in some of the American markets. And it seems to be broadly increasing, which is no surprise because we are seeing more of these types of assets in these markets. So that creates very low prices. At the same time, you have periods where the wind's not blowing and it's the middle of the night and demand is high, as you might get in a high pressure system over the UK in winter, when these assets are not on the system, not bidding in, and that pushes electricity prices higher. And the expectation is that we will see greater price volatility going forward as a result. And that's obviously creates a source of risk for funders going forward. One of the solutions we're seeing here is that although there may be price volatility, there is still demand. And one of the things we're seeing emerging is that corporate buyers are happy to bypass the market itself and to buy direct from assets, perhaps even developing the assets themselves. We're seeing something called corporate power purchase agreements, corporate PPAs. Generally in the past, wind and solar projects would sell their output either to utilities or to companies which effectively acted as aggregators and then sold the power on. The opportunity to go direct is increasing. It's been a bigger phenomena in the United States, but we are beginning to see it appear in the UK and Europe as well. And I think we'll see more of that. And it doesn't get rid of the issue of price volatility, but it is another option. And I think, again, it helps to provide comfort. And with corporate PPAs in place, funding can be more easily put in place itself and taking out some of the risk involved. The other thing we're seeing is that yieldcos, I think, are becoming, I've said, more adventurous. They're certainly looking to different asset types. So this is a sort of, this table shows a quick history of the yieldcos in the UK. These are only the initial offerings. And I've put on what I call the undershoot. I would treat that with a little bit of a pinch of salt, because obviously market conditions have been different at different times. There are other features to that, but generally we're seeing yieldcos have, I think, been a success, but we've seen them move into different asset types. So you can see that the John Lang Environmental Fund there, starting with wind and solar, has moved into anaerobic digestion, which is taking certain biomass and creating methane, and then using the methane to generate power, and waste to energy projects as well, and actually waste treatment projects. We've also much more recently seen the emergence of yieldcos in the storage market. Now, having talked a bit about the volatility, and I've talked about volatility in pricing as a result of renewable generation is intermittent. Solar does not generate energy in the middle of the night, and the wind doesn't blow all the time. One solution to that intermittency feature is power storage. And the cost of lithium-ion batteries has fallen fairly significantly, and it is now credible to offer lithium-ion batteries onto the grid as a solution to that issue. And back in May, we saw Gore Street launch a yieldco based on storage. And what I can say, adding to this slide, is that we have just seen a second yield code, the Gresham House Energy Storage Fund, launched last week, raised 100 million. Target was 200. I think, given the market wobble we've had over the past month, and the fact we're actually getting into a period where people are perhaps thinking more about Brexit, I think that's been a very, very successful raise. So I think we're seeing yieldcos looking at different asset types. And I would say the issue with storage is, unlike wind and PV, you're not seeing very long power purchase agreements. You're not seeing the same visibility of revenue guaranteed. There is an expectation revenues will be very, very, very healthy and very, very good for storage. But it doesn't have the same level of guarantee. So I think that implies that yieldcos are beginning to take slightly more risk and still feeling able to generate the returns and therefore the yields, which is their prime attraction. But I think that is very helpful. I think corporate PPAs and yieldcos are, I think, very indicative of the sort of more creative solutions we're seeing around energy financing and will hopefully continue to see as the market evolves going forward. So just to summarize, I think currently what we call the energy transition, in terms of where money is going, is more about power generation than transport. That may change over time. But I think within power generation, I think new energy is at a tipping point because it's reached a cost level where it is an economically sensible decision to deploy new energy technologies without the need for any subsidies. And as that goes forward, there's a potentially very large investment requirement. The assets themselves have some distinctive characteristics that make that investment perhaps difficult. But I think the market has innovated in the past, and I think we'll see further innovations that will meet that need. So I think, yeah, more evolution to come, but I think there's as much opportunity in that as there is threat. Thanks very much.
Thank you, Adam. 4 questions from Ljubomir. The first one, I think, was answered a couple of slides ago. What is the typical yieldco's portfolio size? The second one, do you typically see wind-only or solar-only yieldcos, or the mix is diverse?
Both is the answer, and I'll just tick back. But I think it's interesting. So there we are. You can see that Greencoat initially came along as a wind yieldco, then Bluefield Solar came as a PV, and then Trig came as wind and PV. So there's a bit of evolution, and then you can see Forsyth has some geographic diversity between asset types. I think a lot of the skills around running a yieldco, so the management company, yes, a lot of the skills are about managing the actual physical assets, and that will be unique to wind, unique to solar, unique to anaerobic digestion. But the other skills, the important skills, I think, are putting around the contract suite, so putting particularly in place output agreements and also O&M agreements, and managing that in a way that delivers the right return at the right risk. And those skills can be common across the different assets. And so it doesn't surprise me that we're seeing perhaps a greater diversity in asset mix, and we may see more of that going forward.
Thank you. What is the minimum portfolio size for yieldco to be listed?
Well, so the smallest there we've seen was Gore Street, 31 million. And this isn't so much about what's the official size, but what is going to provide sufficient liquidity in the market. And I would say about that level, you wouldn't want to be smaller than that. If you end up being too small, you're going to sit there as an illiquid listing. And really the attraction with these investments is that they should be liquid and they should be of a reasonable scale. Gut feel is somewhere closer to 50 is going to be a happier place. And yeah, I wouldn't say the bigger the better, but you know, yeah, definitely that 30 mark. I think it has been the low point, and I think that's probably the low point for a reason.
Thank you. How are typical corporate PPAs structured? How is the electricity price set? At a discount to the prevailing price?
Yes, certainly one would usually expect to see discounts, partly because, as I said earlier, you're seeing an intermittency of supply. Now, there may be ways around that. There may be a portfolio of assets, and we may actually see, and I think increasingly we're going to see storage as part of the solution, and therefore the discount will not be as great. Bear in mind, though, that the corporate may be buying without some of the grid charges that they would otherwise see. And I would say the market is still evolving. There isn't a typical answer, which is maybe not that helpful, but I think that's the way it is. These are often bilateral agreements between parties. And yes, as I say, I think we're still seeing a lot of evolution in the market. So there's no one answer for that, I'm afraid.
Thank you. A question from Paul. If returns are so good, why is there not a boom? Investors would be delighted to make high returns and do good. Suggests there is a cost or limitation not commonly factored in. For example, the space capacity in the UK to have enough wind?
Yeah, I mean, the UK is a small island, and it's not just the space. It's can you find good sites? Remember what I said about the difference between a windy site and a not very windy site. So there is rationing of supply in terms of sites, and that affects returns. And I would say at the moment, returns are fair. I mean, I don't think we're seeing massive supernormal returns. And again, you look at the yield codes, they're delivering generally the returns expected. They are seeing maybe a slight reduction in return for newer assets because they themselves are bidding up the value of some of those assets. I guess that's giving a better return to the developer. So I might throw the question back and say, whose return? But yes, as I say, I think returns feel like more like they're correct rather than supernormal, if that makes sense.
Thank you. A question from Edmund. On sources of funds, on slide 14, something missing was individuals and consumers. Is this category not captured, or is it just negligible? I would guess this has become more significant with consumer scale clean technologies.
Yes, and I think there is an answer to that on one of the other slides. So if you'll excuse me, I'll just click through. But yes, and I think also we're at a slightly early stage. So there is a move towards off-grid or behind the meter locating particularly solar assets and maybe storage assets and even some micro wind turbines at a customer's premises, be they a corporate or even individuals, and that being funded by the corporate or individual themselves. And that often isn't measured. And I think it's not measured. You're right on slide 14. It might be in the unclassified group, but it is seen as a growing area. Now, there will be people funding that itself. So there will be a source of, I think, essentially debt funding seen in that market. But at the moment it's small, but I think that's something that could grow over time and become, I don't think it will dominate, but I think it could become a significant part of the market.
Thank you. A question from Paul. Do we underestimate or ignore the related infrastructural work, so energy, required to cope with new energy generation and use norms and potential demands placed on existing energy and infrastructure system as climate changes?
Yes, we don't ignore. I think we probably do underestimate the impact of these new types of generation. Well, it's already been seen by creating demand for storage, and the fact that we've had two yield codes based on storage goes ahead tells you there is both an investment opportunity, and that investment opportunity based on the fact there is demand for solutions to these new types of generation being placed on the market. You talked also about potential demand, I think, in the question. And demand, as I say, the very first side, EVs maybe not a massive part of the market yet, but as that grows, that will change demand patterns as well. The unknown, I think, is where those solutions emerge. We are seeing storage, and almost going back to the earlier question from Ed there, we might see a lot more storage happening off the grid, even with vehicles themselves being used as a source of storage for the grid, although I think there are a lot of difficulties with that. There's a lot of work being done, there's a lot of interest, there's a lot of potential solutions, but yes, I think underestimated might not be a bad word, but I think this will grow. This is going to be an important area of finding solutions to the changing nature of the electricity network, with more unpredictable generation and unpredictable demand, particularly from vehicle charging, but also perhaps from electric heating as well. Lots of potential solutions, and therefore lots of potential financing, but it still has to evolve. It is moving quickly. As I said, this is a sector under continual evolution, and that really is a way where it's growing.
Thank you, Adam. I think we have time for one final question. Do you see appetite on the market for MENA exposed renewables or yield calls?
Yes, I do, and I'm sometimes surprised. I've been involved, so I've covered a number of companies in certainly more developing countries, and I think we've seen a massive growth of renewables, for example, in India, and I've spoken to a number of companies there who have certainly looked at the yield co or similar structures, but we've not, so far as I know, seen any come forward. But yes, I think very much so. Everything I've said about the asset type, it's wherever they are, they still require big upfront cash, followed by throwing off cash. As long as any additional risk, particularly on the output side, there is a related, and goes back to the earlier question about underestimating some of the infrastructure issues. In China, for example, there's been a lot of wind put up in Inner Mongolia that gets what we call curtailed. The wind's blowing, the turbines are spinning, but the electricity isn't going anywhere. And that could be a risk to a yieldco structure if you were in a location where the grid wasn't allowing the output. But I think, again, that's an opportunity as well.
Thank you, Adam. Thank you for a very insightful presentation. I think the webinar helps us understand how dynamic this field actually is. We always get the impression that financing is a bit of a static and thing that doesn't change much in time, and what you've shown us is exactly the opposite. Next week, join us with Alexis Gray on the fate of the euro. Thank you all for attending, and see you next week.
Thank you.